Hi, everyone. I'm Pamela Hastings, and welcome to another Barometer Wednesday afternoon webcast. It's Wednesday, December 9th. And today we will provide you with a brief market overview and macro look. Joining me today is David Burrows, our Chief Investment Strategist and President at Barometer Capital. And with that, I turn the conversation over to David. We, of course, will be taking questions at the end of this call, so please don't hesitate to email me at phastings@barometercapital.ca, or you can hit us up on the chat and we'd be happy to address them. Thanks so much, and good afternoon, David Burrows. How are you today?
I'm well, Pam. It's hard to imagine that we started doing these in winter last year. We worked our way through spring, through summer, through fall, and here we are headed into the holidays, and we're still here,
and
we are still here. given the range of possibilities, fortunately, most of us are doing okay, and I think all of our clients are staying safe. And so that's a good thing. We talked a little bit about the outlook coming into the election and felt that we were at sort of a point of maximum uncertainty, and that some of the clouds might start to part, and that the market was sensing that over the next number of weeks. And here we are in December, which is, the strongest month of the year, in the strongest quarter of the year. And I think that we're on a fairly good footing. Now, it's not for us to force our way through a market environment. Our job is to really understand what's going on, where the money is going, what is supported by the current environment, and target our portfolios in those areas. So I always like to frame things and say, we have three basic jobs. It's to identify sort of the positive, structurally benefiting parts of the market and focus our portfolios in those areas. Our job isn't to be everywhere. Our job is to identify things that are benefiting from the current environment, and where the outlook is strong and where we see money being put to work. We tend to look very unlike the market. Now, of course, as we go along every day in the process that we go through, both from our top-down work and look at key themes, and our bottom-up work, looking at individual securities, trying to figure out how to express our view. We're always watching for change, new leadership as it emerges, of course, and old leadership as it starts to recede, so we can transition our portfolios and keep them relevant. Of course, there are some periods, and we've seen two in the last 3 years, where you had to play some defense, where very little was working, where the stop losses were a necessary tool to take us out to cash and out of big parts of the market. And frankly, the macro tools helped us to put the money back to work when the time came. So we are trying to be quite tactical about this. Portfolios do change. They're living, breathing organisms, and we apply our process unemotionally to try and make sure that we are in the most productive assets. So this has been a very, very interesting year, because if we'd read the newspaper at the beginning of the year as to what might happen over the course of the year between COVID and all of the machinations and the politics and geopolitics, it might have been a scary year, but in fact, it's turning out to be quite decent. Our base case coming into the year was we were in a structural bull market in stocks that kicked off in 2013, after the market had really made no progress since 2000, and that we are in a structural bull market, and they go on for a long time. The one in the 80s and 90s was 19 years. The ones in the 50s and 60s, 16 years with interruptions, but kind of like 4 steps forward, 1 step back. So if we take the lens in close, the S&P 500 off the lows in March has had really a remarkable recovery. We rallied up until September. We had sort of a typical sloppy fall through September and October. There was lots of things to think about. We had a second wave coming at us. We had an election coming at us in the beginning of November, which was bound to be very contentious. We had lots of difficulties in certain industries. But as we've gone along, we got ultimately vaccines announced. And of course, this week started to be implemented in England, hopefully in the US and Canada shortly. We have had additional stimulus. There is some promise of potentially more stimulus out of the US if they can ever get their political act together. It looks as though the Supreme Court may have sort of put a spike in any last hope that Donald Trump had to reverse the outcome of the election. And so the clouds are slowly parting. We are in very significant, cases from COVID, and that's something that is the case, and it's something that the market grapples with, but it's one factor, and the markets look 6 to 9 months out. And what I would say is markets are behaving very constructively, especially given the types of themes and sectors that are performing well. NASDAQ similarly had some bumpiness in the fall after a remarkable recovery, broke out and made new highs. Today had a wobble, it pulled back a couple of percent, which often happens when you break out in price. You often pull back and test that breakout point. So we'll see where we go from here. This was from about 3 o'clock this afternoon. I think things firmed up a little bit into the close, but certainly, gave up 7 or 8 days of returns. Let's look at it from the point of view that we look at. What we care about is less about the index itself, because it's dominated by the largest, most heavily capitalized companies that have the biggest impact on the index, but the portfolios rarely look like the index. We want to know what the average stock is doing, because if a portfolio is made up of 20 or 30 securities, it is unlikely we have as much Apple as is weighted in the index, or as much Google, or as much Facebook, thankfully not today, as is in the index. We tend to have a broader base of positions. So we want to know, what is the average company doing? And what we can see is in Canada, the US, and around the world, the percentage of stocks, if we gave them each a single vote, the percent of stocks performing well has been rising. The breadth has been expanding. More and more stocks are participating, and that means you're in a healthy market. We have our long-term indicators positive, improving, and all of our short-term indicators positive and improving. So breadth in equities around the world is improving. And we're going to touch on that today, because it's great to have one market doing well, like the US, much better to have a number of markets doing well. It expands the opportunities. It expands our ability to diversify, and it tells us that money is flowing to this group. So here's the S&P after breaking out in 2013, has been working its way higher in a channel. We certainly had some bumpiness in 2015-16, some corrective action in 2018, and a sharp decline at the beginning of this year, but right back into this channel. So we are in a structural bull market. Note that when you break out after many years of not making progress, that tends to be the beginning of a structural bull market. So the S&P has been in one now for 7 years, and they do go on for 15, 18 years. The strongest asset always breaks out first. So the strongest company in a sector will be the first one to make a new high. And then one by one, they follow along in behind. The NASDAQ made its first new high from 2000 in 2016. And that continues today. It's working its way higher. So that was the second major index to break out to new highs. So the concept is, our job is to identify asset classes that have become under-owned and unloved. And then we look for the leading securities or the leading markets in the asset class to start breaking out first, heading higher. And then over time, we want to stay invested so long as the breadth is expanding, as long as more and more securities are participating, as long as more and more markets are participating. That's healthy. There's no bear markets ever happen when that is the case. And oftentimes, bear markets or corrections are preceded by weeks or months of deterioration in the weaklings under the surface before the leaders get hit, the ones that everyone's watching. So we're always watching for deterioration. At this point, we are not seeing signs of that, but you can be the judge. Now, we know the things to worry about. They've been COVID and politics. But on the other hand, we have had tremendous stimulus pushed into the system. So some of this is repetitive, but it's really important to understand 21% of all US dollars in circulation were printed this year. The Fed has liquefied the system. The old saying, don't fight the Fed. Why is that? They make money easy to get your hands on. They hope ultimately will find its way into the real economy, but we know it finds its way into financial assets first. So while they've been printing money, the US dollar is showing some weakness. This is from the beginning of the year. US dollar is weakening. And that breaks a trend that had been in place since 2010. So when people are selling dollars, they're often selling dollars to use in riskier assets, to be more productive with it. If they are devaluing currency, better to take that currency and put it into a productive asset. And it's happening around the world. We've seen booming balance sheets in Japan. We've seen booming balance sheets in the US. We've seen booming balance sheets in the euro. There is a global concerted effort to liquefy the system. And the reason that that's important is in black is the price earnings multiple of the S&P, and in blue is excess liquidity in the system. When there's excess liquidity, the multiple investors are prepared to pay for stocks expands. Well, look at what has happened this year. So it is possible there is room to go. Now, that's not all. US Treasury bond, as discussed over the last number of calls, this is the 10-year bond, has been selling off since August. So as the price of bonds goes down, the interest rate on the 10-year bond goes up. But if you're only getting 75 or 80 basis points, when a bond moves down on $100 from 168 to 158, you've lost a lot of money. So people take money from safe assets like the dollar or like the treasury bond when they think that there is a better place to go with the money. So through the course of this year, we've seen the 10-year bond yield ticking higher. And as that has been happening, the price of bonds falling, money is coming out of the bond market. We've had tremendous flows out, really for the first time in many years, because we've gone so many years of falling interest rates. Bonds are really overowned. Now, some people have to own them. Insurance companies need to own bonds. Pension funds need to own bonds. Banks need to own bonds. But Jamie Dimon said this morning in an interview, personally, he wouldn't touch a treasury bond with a 10-foot pole to tie your money up for 0.9% for 10 years when inflation is going to be greater than that and you pay tax. Makes no sense. But you do it when you think it's the only place to go. So what's happening? Money is working its way into stocks. We've had the biggest flows into equities over the last few weeks that we've had in 10 years. And that's important. Now, it's not a fluke, and it's not because people are being flippant with their money. They're getting paid well to take risk. So this is a chart that shows the equity risk premium. That's a fancy word for saying comparing the yield on a 10-year bond to the earnings yield of an average company. If a company's earning 10% on its capital, then there's an earnings yield of 10%. So we track over time the earnings yield of the S&P 500 minus the 10-year bond. You can see currently you're getting an extra 246 basis points or 2.4% to take equity risk. The average over a very long period of time is 60 basis points, but it has varied widely. In fact, people in 2000 were so anxious to own stocks, they were happily taking 3% less in earnings yield than they could have had in a guaranteed piece of paper, a 10-year US bond. That was the time to buy bonds. Now is not the time to buy a lot of bonds. You're getting paid to take risk. So equities give value relative to the alternative investments that you could make. In the S&P 500, 63% of stocks pay a dividend higher than a treasury bond. Now that's important because you'll remember last week we talked about the concept that when rates start to go higher, dividend growth becomes important. Getting a dividend yield that can grow offsets the impact of rising interest rates. So this makes the S&P look about as interesting versus bonds as I can remember back to the 1990s. Now, I talk about yields going higher, but let's put it in context. This is the yield in a 10-year bond since 1980. This is the increase in 10-year bond yields we've seen since summer. It's minuscule, but it's translated into like a $12 or $13 per 100 in price. So even if we simply have a rally in yields like we did in 2016 or like we did in the early 2000s where you just rallied into the long-term downtrend, that would take yields closer to 2.5% from where they are right now at 90 basis points. So no wonder people are reducing their holdings in bonds and moving their money to equities. Now we talk about the concept of breadth. The strongest asset breaks out first. And as time goes by, money starts to spread to other assets if you're in a healthy environment. We know that while the NASDAQ and the S&P, made all-time highs quite some time ago, we just made a new all-time high in the Russell 2000, which is sort of the mid-cap or mid-sized company part of the market. Certain industries have been joining the rally. Certainly dividend growth as a theme has really joined the rally. Relative to the S&P, it's been improving, broken out to new highs. In fact, 89% of all of the industry groups in the US are now in an uptrend. So the more, the better. It means that buying is broad-based. It means that there is lots of money getting put to work. And it tends to be that when you get to these points where a very high percentage of sectors are performing well, it's relatively early in a rally. So I know it seems like here we are at a new high, market's at a high, it must be risky. Actually, the market is the least risky when a high percentage of industries are performing well. That tends to happen early in a cyclical advance. So I would say the market is sensing we are headed into a new business cycle as we get through COVID. And yes, we've focused on the US, and certain areas of the US market really benefit with rising rates and reflation. Certainly the financials haven't made a new all-time high since 2007. We're not there yet, but we're getting close. So financials have been in a structural bear market like US stocks were between 2000 and 2013 since 2007. And when we start to exceed this high, that will kick off a new cycle in financial services. Now the brokers and the asset managers already are making new highs. Morgan Stanley's a great example, but it's one of the strongest assets. The strongest companies break out first. Healthcare has been doing well, large cap, but small cap healthcare has broken out of a range it's been in since 2018. That's a broadening of the market, small cap securities participating. Now, as the US dollar has been weakening, that also means that it is likely money is leaving the US to invest in other places. When we break a long-term uptrend like this, it is significant, and it can go on for a long time, certainly in fits and starts. So we've seen tremendous flows into global equities. The biggest 2-week period on record leading up to last week, back to 2008. We talked about the US market breaking out in 2013, the NASDAQ breaking out in 2016, certain industries breaking out recently. The Chinese market just made its first new high since 2015. That's a new structural bull market beginning. Now, the better assets within China, certain industries, are doing better than that. So more interesting than the broad market, like Chinese internet companies, which are making not just new multi-year highs, like the Chinese market is, but new all-time highs. Chinese technology is doing the same thing. That is leadership in the Chinese market. We own Chinese technology, Chinese web, and Chinese consumer, which is obviously a growing consumer class. The Taiwanese market over the last number of months has broken out to new all-time highs since 2000. The Korean market just breaking out to new all-time highs. So my point here is, it is great that the US market's performing well. And it's great that lots of industries in the US are performing. It's even better that the rally in stocks is broadening to other major geographic regions where new bull markets are just beginning. Now, it doesn't make them the best markets because the best markets break out first, but it certainly means that the appetite for equities is growing. Japanese bull market starting basically in the last month for the first time since 1991. So let's come back to another asset class. We've talked about domestic equities performing well, broad-based rally in many sectors. We talked about global equities participating, performing well. We talked about bonds as an asset class as one that is a source of cash that is moving from there to somewhere it's treated better, global equities. But we're also seeing some strength in commodities. After a long period of underperformance, 8 years, Gold stocks broke out earlier this year. And as I said at the beginning of the call, when you break out, you often pull back and test that breakout before going higher. In the last 2 weeks, the gold stocks and the silver stocks, both this is large cap golds and this is small cap golds, have broken out and pulling back. Excellent entry point. Now, there are some that are making new all-time highs, not just testing a multi-year range. And those are the ones we want to focus on. There's gold going back to 1993. This was the bear market we went through in the late 90s. It took 3 breaks of the trend line before it really got going. We've done the exact same thing here. I think we're in the very early stages of a new bull market here. Now, it's not just golds. You know, metals companies that produce iron ore, copper, zinc, are also breaking out of a bear market that they've been in since the mid 2006, 2007 period. Now that's the whole index, but then you find companies like Rio Tinto basically breaking out of major ranges and close to all-time highs. So the common factor here is these are all assets that people buy when they're willing to begin to take more risk. Now, arguably, Rio Tinto is a $120 billion company with a 5% dividend attached to it, with a broad-based list of assets. But if commodities have been in a bear market for a very long time and are just starting to make new highs, that's a new structural bull market. Even the TSX, the Canadian stock market, is breaking out to new highs for the first time since 2007, really substantially getting out of the range. Now, the Canadian market we know is more tied to commodities, more tied to China, more tied to emerging markets. But certainly it's a good thing that the Canadian market is finally getting out of neutral. So I believe we're in a structural bull market for equities. It is broad-based by sector. It is broad-based by market caps, large cap, small cap, mid cap stocks. Growth stocks are rallying, value stocks are rallying. We are fairly fully invested. And we believe that what will happen for years is money will slowly come out of fixed income that's been in a bull market since 1980 and migrate into equities, much as it did at the beginning of this bull market in the early 1950s as rates bottomed at 1.6% and then went higher for the next 20 years and stocks went along for the ride. So since September, a different group of equities have led the market. Higher beta, meaning more economically sensitive, micro cap companies, small cap companies, Japan, mid cap, financial, emerging markets, industrials, China, materials, risk assets. And NASDAQ had a quiet period, seems to be coming out of it, we'll see, but the money is coming out of treasury bonds. So if you look at where we're positioned, we watch every day our models at the sector level and at the market level for signs of risk. We are seeing strength in many leadership groups. We are, of course, most focused in the US, and from a sector perspective, raising our technology weight again, still less than market weight because there are other things to do. Industrials have been a source, a destination for investment dollars. We've been increasing our weight to financials. That's now an overweight position versus the S&P. We have an overweight position in materials because we think we're early on in the cycle. And then we have smaller positions in things like consumer staples, utilities, government bonds, communication services, things that act more like bonds that are less economically sensitive. Now, we watch for risks every day. But a week ago, if we took all of the major markets globally and put in green those that are showing expanding breadth, the average country had 54% of its stocks in uptrends. As of this week, almost 56% of stocks in uptrends, and actually 2 more markets have joined the green camp. The rally continues to expand. So in the last 5 weeks, the average stock in the US has blasted off to new highs. Each bar is a week. And we would call this a breadth thrust. This is all stocks in the US equally weighted. when you have a significant multi-week thrust of buying across across sectors and themes and market caps, we call that a breadth thrust. If you took each of the times this has happened since 1980, and there's 20 of them, and look at what happened over the following 12 months, the maximum gain was significant. All of them were positive. If you looked at the maximum drawdown after that took place in the next year, very small pullbacks. So look, sentiment is becoming very optimistic. Certainly the market can always pull back. I would say that these types of pullbacks would not be a disaster and should be expected. But these were the maximum drawdowns in the 12 months following these breadth thrusts. So I would say we've got a ways to go. These were the returns that were had before the next 15% correction. So I think it's time to be invested. It's time for us to be in groups that are more economically sensitive. If we do have cash, it is time to be putting more cash to work. If you were concerned about the election, likely the outcome is hammered down. If you were concerned about not finding a vaccine, it is likely the vaccine is going to work its way through our population. If you were worried about the Fed making a mistake, the Fed has made it very clear they intend to stay accommodative. So we have to be taking advantage of this situation. Volatility has been falling since March. It continues very low, even after a sloppy day like today, but it's still well above where we were through 2016, 17, 18, and 19. As volatility falls, it tends to be that equity returns go higher. So we'll watch for any sign of trouble. And of course, we do these calls every week. If we see something happening in the meantime that is real cause for concern, we'll certainly talk about it. But right now, I believe we are still very early in the next business cycle, and we likely have some pretty good running room in front of us. So we look forward to taking advantage of it. With that, Pam, if there's any questions, I'm happy to answer them.
Hi, Dave. Yeah, no questions today. We have a quiet audience. So I guess we will probably do another Wednesday afternoon call next Wednesday, and then maybe take a hiatus over the holidays and then come back fresh in the new year, the first week of January.
That's great.
And to all of those who celebrate Hanukkah, happy Hanukkah. It starts tomorrow evening.
Thanks very much, everybody. Everybody, please stay safe.
Thanks, everyone.
Thanks,
Bye.
Pam.